Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video I would like to share with you guys 7 different companies that have A+ credit rating from S&P. That means these companies do not have basically a lot of debt, and if they do, is a very small, and of course they are able to cover. There are different ratings. Okay, so if I will quickly show you here, this is the column that we're looking at. So S&P, as you can see here, A+ rating is the number 5 here. That means upper medium grade, and that tells us basically these companies have a healthy balance sheet, that you don't have to worry about these companies being bankrupt or anything like that. The higher the better. The highest the one company that I own in my portfolio that has a AAA, even the United States, basically the government does not have AAA rating, and that company is Johnson & Johnson. I think Microsoft and Johnson & Johnson are the only 2 companies that I'm aware of that have a AAA rating from S&P Global, which is absolutely crazy. Right, as you can see here, alhamdulillah, the portfolio has now gone over £100,000. That's just crazy to even say out loud. And right now we're in the basically green for over 14%, or £12,000, over £12,000 right now. Alhamdulillah, things are going well. Let's see what happens. You know, as we always say, the stock market is very unpredictable. It can go up, it can go down. As long as you keep buying quality companies and holding your portfolios, whether they buying, you're buying stocks, individual stocks, or you're buying the the ETFs. Okay, it doesn't matter. I'm going to do a quick update on some things that some changes I made to the portfolio. I've added a new stock. As you can see here, we now have got 26 investments. So I will share that with you guys soon, inshallah. But let's get started the video, because I don't want to make it any longer than it needs to be. And the first company that we're looking at today that has a credit rating of A+ is Eli Lilly. Some of these companies, I warn you, are very, very expensive right now. So if you're interested, just put them on your watch list and leave them alone until they hit your price target. So entertainment purposes, I want to share this with you guys, but please be mindful. Some of these companies are very expensive right now. It has a market cap of $680 billion. I wouldn't be surprised if this one hits $1 trillion sooner or later, the way it's going with that weight loss, drugs and so on. It has a wide economic moat, $757 per share right now. Dividend yield just less than 1%. Payout ratio 72%. Now the reason this is actually gone up is because the company has a negative free cash flow right now. I'm assuming this is just a temporary thing, because there's nothing to worry about, because as you can see here, in terms of safety, we're looking about 96%. And as you can see here, right now is basically 51% premium. $500 per share is where they think the price should be, according to Morningstar valuations. But in terms of dividend, 15% increase latest, 15% in the last 5 years. They've increased that dividend for basically 9 years. Annual payout of $5.20, which is quite nice. And profit margin, return on equity, return on invested capital, absolutely wonderful. The growth side of it is absolutely great. Look at this. This is the reason why a lot of people are basically paying a higher premium for this company. You're going to get 51% per annum in terms of basically increase. In terms of the EPS increase, and that's absolutely ridiculous. Let's move on to the next company. And before I do that, I just want to show you basically what Seeking Alpha is saying about Eli Lilly. So if you go to earnings, as you can see, 97% this year, 45%, 30%, 22%. So double digits, and there's so many people looking at this company. This has now become the Nvidia of basically drug makers. So again, looking at 21%, 23%, 17%. Although, yes, it's trading really high, unless, it's too expensive for me. I wouldn't touch it right now. Next one is Cummins, $38 billion market cap right now. It has narrow economic moat, $269 per share right now. Dividend yield of over 2%, and payout ratio only 33%. Latest increase was 7%, and 5-year growth rate of 8%. Dividend streak of 18 years. Another 7 years, this company will become a dividend aristocrat. $6.72 is what you will get for every share of this company that you own. 98% safety, profit margin of 12%, return on equity 29%, and return on invested capital of 19%. $2.7 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 8%, 14% in the next year, and then 7% after that. 12% premium right now. It wasn't not long ago that I was talking about this company being really cheap, and now it's gone up quite a bit. $240 per share is where they think the price should be. And looking at in terms of growth side of things, we're looking at minus 6%, for basically this year, and then 13% for basically 4% after that. Negative again in terms of in revenue side of things, 5% again, another 5% in basically the following years. Next one is Illinois Tool Works. This is one of the companies that I've actually talked about so many times, but I haven't bought it. So, and yeah, I don't know why I haven't, but it's one of those companies. Actually, I was looking at it a while ago, and it was really cheap at the time. But right now, it has a market cap of $78 billion. It has a narrow economic moat. Prices $263 per share. Dividend yield of 2%. Payout ratio 56%. Latest increase was about 7%. I think one of the reasons I haven't bought this is because I've got a lot of industrial companies in my portfolio at the time. Dividend streak is to 52%. Payout ratio right now $5.60. Safety 81%. Profit margin of 18%. Return on equity 96%, which is huge. Return on invested capital of 35%. $3 billion of free cash flow right now, 14% total return in the last 10 years, 8% growth estimate for next year, and then 4% after that every single year. 25% premium right now, $211 per share is where they think the price should be. And seeking alpha earnings side, things 4% right now, 8%, 10% almost, and then 11%, and then 12% after that. 2%, 3%, 4%, and so on. So nothing huge there, but it seems very expensive right now. The next one we're looking at is Apple Laboratories. This has a market cap of $210 billion, right? Narrow economic moat. Price right now is $120 per share. Dividend yield of 1.82%. Payout ratio 47%, which is low. Latest increase is about almost 8%. The 5-year growth rate of 12%, dividend streaks of 52 years in a row, annual payout of $2.20, safety 90%, profit margin of 14%, and return on equity 15%. Return on invested capital 13%, $5 billion of free cash flow right now. Total return the last 10 years, we're looking at about 13%. Next year, they're expecting the earnings to grow about 11%, then 8% after that, 16% premium right now. I told you, these companies are expensive, $104 per share right now. And looking at Seeking Alpha, as you can see, 4%, 11%, almost 11% in terms of growth, 4%, 7%, and 7% as well moving forward. Next company that we're looking at today is UPS, another one that I own, another one that is in the industrial sector. 134 billion market cap, wide economic moat, $157 per share right now. Dividend yield of 4%, over 4%, which is quite nice. Payout ratio 74%, which is not nice. So hopefully that can come down after the company starts actually to recover, because it has been down quite a bit lately. Latest increase was 0.6%. I think they're just doing it just to keep up the increasing that dividend. 12% in terms of the last 5 years, which is nice. 14% of increasing that dividend, so they don't want to lose that, so that's why they're probably increasing it. And annual payout $6.52. Safety 69%, profit margin of 7%, return on equity 36%, and return on invested capital of 20%. They have $5 billion of free cash flow right now. Total return the last 10 years, we're looking at about 7%. Growth estimate of next year about 17% for this year, and then next year, and then minus 6%. And fairly valued, the only one I think that we've seen, well, the only one that I was seeing so far that is fairly valued, $158 per share is where they think the price should be. Right. Well, now looking at Seeking Alpha, you can see basically that decline basically for 2024, and then 17% bounce back, 8%, and then 12%, and then 9%, which is quite nice. In terms of revenue, is basically as 2%, 4%, 4.5%, whatever that is, 3%, and then another 5%. So nothing huge there, nothing to worry about. So steady Eddie kind of grower. So let's see how it goes in the next 5 years or so, because that's my plan to hold on to it for the next for at least a minimum 5 years, if not longer. Texas Instruments is another one that we're looking at today, $159 per share. It has a wide economic moat, $172 per share. Dividend yield of 3%. Payout ratio 71%. Latest increase of 4.8%. And the 5-year growth rate of 14%. Dividend streak 20 years right now. So that 20 years means that another 5 years will become a dividend aristocrat. Annual payout of $5.20. 80% safety right now, profit margin 36%, return on equity 41%, and return on invested capital 25%, which is quite nice to see. $1.3 billion of free cash flow right now. Total return in the last 10 years 16%. Growth estimate for the next year 28%, which is absolutely huge. Then 10% after that, 20% premium right now, $146 per share is where the price should be, or basically where they think the price should be. Now, this company has recovered quite a bit, because not long ago, actually, they were saying it was a basic similar to Qualcomm. The earnings were supposed to decline, but something has happened, and look at it now. And looking at Seeking Alpha, we've got 26% decline this year, 29% bounce back, almost 20% there, 26% there, and 14%. And then same thing, more or less, 10% decline, and then 14%, 12%, 17%, 2%, and so on. And final company for today is W.W. Grainger. This company, I don't think I've spoken about this company because it's always been expensive, but I thought today I will include this. This is one of the companies, I told you, I love the industrial sector. This is one of the companies I wanted to add to the portfolio a very long time ago when I first started. It was one of the companies I came across, but it's always been expensive, so I've left it out. So $47 billion market cap, narrow economic mode, $975 per share right now. Dividend yield just below 1%, payout ratio only 20%, and then 8% latest increase. 5 year of 6% growth estimate side of things. Dividend, 5 years of basic dividend. I can't even talk. Dividend growth rate of 6%. Dividend streak of 52 years in a row. So they are dividend king. I think there's 2 dividend kings. Well, 3 dividend kings on this list today. And annual payout $7.44. Safety is 99%. Profit margin 11%. Return on equity 65%. And 42% in terms of return on invested capital. Free cash flow right now 1.5, 15% in terms of total return the last 10 years, which is quite nice. They expected the earnings to grow about 9% next year, and then 28% after that. 77% premium. This is probably one of the most expensive companies I've looked at. $550 per share is where they think the price should be. Looking at the earnings expectation side of things, so about 7%, 9%, 6%, 7% there, another 6%, 6, 7, 7% there. So yeah, nothing huge, but there is. So now what I'm going to show you is the Sharia compliance side of things. You can pause the video and have a look at it. There's no issues with any of these companies. It seems is okay. The only one that has a little bit higher in terms of interest-bearing debt is the Cummins, as well as UPS. UPS is about 20% as well. So other than that, they seem to be okay. Like I said to you guys, some of these companies are very expensive. So just add it to your watch list if you're really interested, and do a little bit more research. Okay. And definitely will help if you can join us here. It takes a lot of time to put these videos together. So InshaAllah, if you can join us here and you share, whatever you're doing, InshaAllah, in terms of buys and sells with the brothers that are actually talking to each other on daily basis on the Discord, that will be really helpful. Have a wonderful day. Assalamu Alaikum.